Hey guys, hope you're doing well out there. Google just reported their Q3 results and shares are popping nearly 5.5% in the after hours. That is despite being up close to 1.6% on the day, and even over the past week, you're up over 5% with shares of Google. So we'll get into their Q3 results, what exactly it is that makes this quarter so spectacular for Google. We'll take a look at the revenues, the profits, the all-important dividend that this company is now paying out, the cash flows, what they really are doing with that in terms of a buyback perspective. We'll also take a look at it fundamentally and see why there's still room to the upside. And then when we get over to the technicals, yeah, you see this one still near the middle of the channel, and you probably have another 10 to 15% of airspace above this one, believe it or not, for shares of Google to run. So in this video, we'll walk through exactly what it is that makes Google so special and why this can be one of the core companies in your portfolio, why it can be one of those cornerstone holdings that continues to move your portfolio higher. Because year to date, you're up roughly 21% with shares of Google. Over the past 1 year, you're up around 36%. And so while you haven't seen the same alpha or outperformance from shares of Google in the past, I think the low valuation still allows this company to continue to move higher in the near future, in my opinion. Now, revenues came in at $88.27 billion. That is for the last 3 months. Yeah, that's not for a full year. That's over the last 3 months. That's nearly $1 billion a day. Yeah, think about that. $1 billion a day in terms of top line revenue consistently over the last 3 months. That is incredible to see. That is also nearly 15% growth year over year, beating estimates on Wall Street by a cool $2 billion. In terms of the GAAP EPS, that came in much higher than what Wall Street anticipated at nearly $2.12. And like we said, on the initial day, shares up nearly 1.6%. In the after hours, you're seeing shares pop by another 5%. Now, as we look ahead to next quarter, we know the fiscal Q4 is the holiday time period. That's really when ad spending takes a hold on really all of the advertising sites like Google, like Facebook, like even Pinterest and Snapchat to a lesser degree. And so Wall Street is anticipating nearly 95, close to $96 billion in terms of top line revenue. The high end is for 98.5. So I really doubt Google will come in there, because you're looking at nearly an $88 billion this quarter. It would be very, very difficult, in my opinion, for Google to come in and post a $98 billion next quarter, but certainly 96, maybe as high as $97 billion if ad spending in the upcoming holiday quarter looks really good. Yeah, that's certainly doable, and I think that can propel shares further higher as you're expecting another 11 to 12% upside on the revenue growth rates. In terms of bottom line profitability, that is really where the levers continue to move for this company. And as we saw, their Q3 came in with a huge beat. $1.85 was expected. This company came in with $2.12 on the bottom line earnings. So certainly $2.04 is very, very conservative for this company, considering they came in with a beat on their Q4 EPS estimate in their Q3. And so I'm guessing they'll easily beat these $2.24 estimates for the upcoming Q4. Maybe even as high as $2.50 is what I would expect Google to post for the upcoming Q4, because as we see, this company is just driving huge amounts of operating leverage in their business. Any top line revenue dollar is churning out into bottom line profitability so effectively. You'll see that when we get over to the segment results. Now, the other thing you have with Google is not just a regulatory overhang that is certainly putting pressure on this stock, but also you have the questions whether Google is losing market share in terms of search. And certainly Meta is one of the competitors that is growing as a competitor to Google, probably taking away some of the market share. You also have other chatbots and LLMs like OpenAI's ChatGPT. You also have Anthropic taking away a little bit of market share, in my opinion, from Google's search business. But currently, Google continues to lead the market with nearly a 90% search share. And as we walk through these results, you'll see exactly why their market share certainly is stable for the current time. And I think for the near future, no real doubts in terms of their search market share. In terms of the dividend, you also got that 20 cents per share. That's on a quarterly basis, forward yield of nearly 0.5%. I think that's another reason why you continue to buy and hold shares of Alphabet, is because this company, maybe 5 years, maybe 10 years down the line, will be a premier dividend company, a premier dividend growth company as well. In terms of the different segments, you have the all-important Google services. This includes things like YouTube. It also includes things like Chrome and Android and Maps and a whole bunch of other Google services. We can break that down in terms of the search business itself. Last quarter put up $44 billion. This quarter it jumped up to nearly $49.4 billion. So you added on close to $5.5 billion on just the search and advertising bread and butter business. That is amazing to see. That's very fast growth for the Google search business that continues to, again, fend off competition from not just regular search like Facebook, but also fend off competition from the LLMs like OpenAI and Anthropic. In terms of the other parts of Google services, the YouTube business continuing to chug along, adding nearly $1 billion dollar for dollar, as last year you were at 7.9, that jumped up to 8.9 billion on that revenue side. The one hole to point out in this report would be on the Google network side, as your revenues there actually declined from 7.7 down to 7.55. But all things considered, your advertising revenues continue to move higher. Your services total business goes from 67.9 up to $76 billion. That is incredible to see. $76.5 billion in a quarter. Keep in mind, all of these are quarterly figures, and so just these staggering numbers that this company puts up. What's even more impressive is how well these revenue dollars are translating into operating income dollars, because like we said at the top, this company is expected to grow those top lines, nothing out of the ordinary, I'd say 10 to 12%, but what that does is, as it comes down to your operating income, because this business has scaled out so well, nearly 60 or 70% of that revenue dollars are now flowing in to your operating income. Because look, you added close to $9 billion on your Google services side in terms of top line revenues. You added close to $7 billion of those $9 billion in your operating income. So again, 7 billion of that 9 billion flowing all the way down to the operating profits or the operating income for that services business. Similar story on the cloud side, 8.4 up to 11.3 billion on the revenues, and your operating income on the cloud side nearly, call it 10xing, up from 200 million up to nearly $2 billion in terms of Google Cloud operating income. So as this company continues to scale out the Google Cloud business, still relatively low margin, I'd say close to 10, maybe 12% operating margins on that cloud business. We know AWS has margins close to 40%. So I think over time, I think Google Cloud can certainly get closer to 25, 30% even. And I think that certainly will continue to move the needle over at the Google Cloud business. Overall, continue to also move the needle at shares of Google. In terms of the other bets, certainly they continue to lose money, but that's on things like Waymo, other healthcare related services, also some of their internet services. So they're, I believe, not looking to really make money from their other bets, similar to how Meta loses some money on the metaverse projects. I think what comes out of the other bets likely down the future can be very exciting. Similarly, you have some losses on the Alphabet level activities. Some of this is right-sizing their business. Some of it is also getting rid of physical office space in downtown areas that are really expensive. And so those losses certainly did accelerate. I think year over year, you could maybe look to reduce those moving into 2025. But the core business over at Google, the bread and butter services business, the advertising business over at YouTube, along with the cloud business, continues to stay extremely strong. Revenues moving in the right direction. And what's even more impressive is how well they're controlling those costs, allowing them to balloon those operating profits. In terms of the balance sheet, everything looking as you would expect, nearly $93 billion from cash and cash equivalents. That did trickle down just a little bit over the last 9 months. We'll see where that cash went when we get to the cash flows, but all things considered, nearly $150 billion in current assets. You don't have a whole lot of liabilities, nearly 50 billion in accrued expenses. You have some revenue share that accounts for the revenues that creators get paid out here on YouTube. And then you have roughly $12 billion in long-term debt. So all things considered, nearly 116 billion in total liabilities. And you have almost more than that. In fact, you have well excess of that in terms of current assets. From a balance sheet perspective, this is the reason why this company began to pay out a dividend and probably has a long runway ahead of itself to continue to raise that dividend in the upcoming years. In terms of the financial statement, we talked about the top line revenue growth. $12 billion is what you added on year over year. And what's even more impressive, I've said this before, is how well this company controls their costs. Nearly $3 billion is what you add on to the cost of revenues. R&D taking up just a shade over $1 billion. Sales and marketing staying relatively in line, and then your G&A expense actually coming down from 4 billion down to 3.6. So that allowed their total costs and operating expenses to move up just $4 billion despite raising nearly $12 billion on those revenue side. Again, allowing those operating incomes to balloon to nearly $28.5 billion. Last year, you were just a shade higher than $21.3 billion. And that basically trickles down to your net income as you add nearly $7 billion to your net income, again, off of nearly $12 billion on those revenues. And so that is why when a company like Alphabet only grows maybe 10 or 11, maybe even as high as 12% on the revenue side, why that's so impressive is because how well they have scaled out and how well those revenue dollars will ultimately get translated into bottom line net income dollars. And what they're able to then do with that net income is a whole lot of activities. So first of all, they can buy a bunch of property, plant, and equipment. This is really used for them to build out their AI infrastructure, to build out their servers, their data centers, to invest in those tensor processing units that they build in partnership with Broadcom. All of those things give them the competitive advantage to at least stay in the game, stay competitive with AWS, stay competitive with Azure, and then continue to move the needle on the Gemini project. And so they're investing heavily into purchase of property, plant, equipment. This also shows up on their balance sheet side. If in case you were curious on the assets, you see the assets on the property, plant, and equipment coming up to $161 billion. Last year, same time, you were closer to $135 billion. So certainly the additions to property, plant, and equipment over the last 9 months, even over the last 3 months, have been meaningful, certainly do show up on the balance sheet. Other than that though, they continue to buy back their stock to the tune of nearly $15 billion, began to pay out that $2.5 billion buyback, and then the rest sort of just pay off that debt or at least refinance it to a certain extent. And so that allows them to be a very shareholder friendly company. You get a dividend, you get a buyback while you continue to get this company investing or at least reinvesting back into themselves to continue to push the needle on the top line growth. And certainly all three of those things is what you like to see as a shareholder. Now, in terms of a technical perspective, this company has been in a steady pattern of higher highs and higher lows dating back to October of 2022. So nearly 2-year uptrend that continues to remain intact and continues to move higher. I think you, believe it or not, still have room to the upside, up as high as $200 a share. Until then, I think Google and shares of Google continue to be a buy, believe it or not. You can continue to dissect this channel in half if you really want. And so you're coming up just to the halfway point of this channel at the current time. Maybe you get rejected near the $180 range. What I think is actually more likely is you continue to move higher up closer to the 200s. And that's a point where you can at least look to take a breather in buying shares of Google. Maybe if you really want, you can look to sell some shares, but certainly I think this company is a long-term buy and hold. The fundamentals are really telling you it continues to be a buy and hold. The technicals also indicating that shares of Google continue to remain a buy, as this one has been intact in that long-term uptrend that really I see there's no reason for it to break down anytime soon. That was my take on shares of Google, a steady company that produces consistent cash flows, consistent net income profits, and continues to move higher. One of the reasons why I think you can make Google a core holding in any portfolio, really. Let me know your thoughts on this one in the comment section below. As always, stay tuned on the channel as we'll be covering more of the mega cap tech earnings as they roll in. Thanks so much for listening, and I'll catch you guys in the next video.